right. So I just wanted to ask you a quick question about income protection. So what is income protection?
Probably not a quick question, but income protection can cover up to 75% of your personal exertion income, so what you earn. So say you earn $100,000, potentially you can get insurance up to $75,000.
So why can't you insure yourself for a full 100%?
Well, firstly, the insurers don't allow it, but some of the reasoning why they don't allow it is if you're earning, I guess, full income or full wage from being off sick or injured, potentially there's less incentive to go back to work, which therefore may mean that you don't do your rehab as well, or you don't go back to work as quickly as what you may do only earning 75%. So it's designed to allow you to get by but not live like you normally would.
Right, okay. Yep, makes sense.
But essentially income protection will pay out if you're sick or injured and unable to work. Now, there's a lot of differing income protection contracts out there. So there's ones that you can just call a hotline and get within a couple of minutes. Yep. There's one that you can go through a financial advisor and get, or there's ones through your super fund or industry super funds. Now, all of them have differing terms and conditions and things like that. So I guess one thing to note with all of this is some contracts will pay outside of work, overseas, 24/7, whereas others may not. So it's really the devil's in the detail when looking at an income protection contract. But I guess broadly, it does cover you if you're sick or injured and unable to work post your wait period.
Right. And what's the wait period then? You just mentioned that. How does that work?
So a wait period is, I guess, the qualifying period for how long you have to be off before you start receiving what you're insured for, up to 75% of what you earn.
Yep.
So as an example, there's contracts that offer 14-day wait periods. So what that means is you've got to be unable to work for 14 days, and then assuming you meet the terms and conditions of the insurer, you'll start getting paid. Some insurers, just to, I guess, get a little bit more complex, will offset sick leave and things like that. So if you're eligible for sick leave, potentially you have to use all your sick leave before you start getting paid. But I guess at a real high level, the wait period can be 14 days, 30 days, 90 days, 2 years. It really can range. And that's the length of time you need to be off work before the insurer will consider paying you the claim. They don't backdate the claim to the date of injury or illness as well. So they start paying from that date forward. So as an example, if you have a 30-day wait period, you're off work for 30 days, the insurer doesn't start paying you from day one, they start paying you moving forward.
Okay, so like they basically pay you monthly in arrears then, is that what you're sort of saying?
Yeah, so if you've got a 30-day wait, your first payment wouldn't be until 60 days.
Right, so you've hurt yourself and then theoretically 60 days later you would actually receive the money. Is that what you're saying?
For 1 month only,
Yep.
And then moving forward.
Every month after that you would then be paid. Yep. Right, cool. How long do you get paid for then?
Okay, so the second component of a income protection contract is the benefit period. So benefit period, how long will I be paid for if I'm off work, unable to work, sick or injured? Okay, so examples may be 2 years, 5 years, or until you turn 65 or age 70. So as an example, if you've got a 2-year benefit period, if you're unable to work for, say, 5 years because of an illness or injury and the insurer admits your claim, they would stop paying after that 2-year mark.
Right,
okay. But if you had, say, an age 65 contract, so that would mean that you would continue to get paid, assuming, again, you meet the insurer's criteria, until you go back to work or until you reach age 65. So really trying to, I guess, protect you for the long term, which is really beneficial, I guess, for younger people.
Yeah, it makes sense. So you mentioned before that like your super fund may pay for your income protection. So is that the only way that you can pay for income protection? Is there different ways that you can pay for it? How does that sort of work?
So income protection, broadly speaking, can be paid in 3 ways. Through your super fund, okay, whether that be your industry super fund or a retail super fund, can be paid through super. The other option is that you pay for it out of your own bank account or credit card, but your cash is
Yep.
paying for it.
Okay.
Now, by doing it that way, the premium is tax deductible. Okay, so you are able to claim the income protection premium that you pay over the course of the financial year in that year's tax return.
Okay.
So it can be quite beneficial if you're earning a decent income,
Yep.
because essentially whatever your marginal tax rate is, that's the deduction you'll get on that premium.
Right. Okay.
But the third option is a bit of a hybrid of the two.
Okay.
So this is commonly referred to as super linking within
Right.
the industry.
Okay.
So what this enables is the majority of the premium, about 90% in most cases, is paid from your super fund, and about 10% of the premium is paid by you or your bank account.
Okay.
Now, you're probably going to ask, why? Why do this? Why not just have the super fund pay for it? There are potential risks that we look to mitigate in the event of claiming when it's held through super.
Okay.
So when you hold income protection through super, you've got to also meet the CIS conditions of release, which is the superannuation law of condition of release.
Mhm.
So the insurer says, yep, Alex, you're sick or injured, you've met your waiting period, we're going to pay your claim.
Yep.
It goes into your super fund.
Okay.
You then need to ask your super fund for that money. Now, the super fund has to go by a set of rules before they can release money. So conditions of release of a super fund: passing away, permanent disability. But the one where income protection falls under is the temporary disablement clause.
Right. Okay.
Now, part of that clause means for you to be able to get the money, you need to have been gainfully employed at time of injury or illness.
All right. So you have to have a job when you got injured.
Yeah,
Basically.
so you can still have income protection or hold it when you don't have a job,
Yep.
and you can still pay the premiums, and essentially you're still insured.
Mhm.
But there could be examples that we've seen in the past where potentially you go on maternity leave, or you're made redundant. There's essentially potentially a period of time where you're not employed, and it
Okay.
may be short, it may be long. You're still paying the premium, or your super fund is still paying the premium. In that time you get sick or injured, well, you can claim, but potentially it won't reach your bank account.
Right. Okay.
So essentially by doing that hybrid option, long-winded answer, mitigates the risk of you not getting the money and it being blocked at the super fund level.
Cool. So then, just to summarise, then from what you're saying, there's various different types of income protection contracts out in the market, and like you said, the devil's in the details. So make sure you check that. You can cover up to 75% of your gross annual wage. There is a waiting period on an income protection contract, which can be 14 days right up to 2 years, depending on sort of what you pick. Yep. There is then also a benefit period, so how long they pay you for when you are sick or injured, and that can be sort of 2 years or up to age 65, you were sort of saying. And then there's sort of three ways you can pay for your income protection contract, being you pay for it out of your own bank account, your super fund pays for the whole thing, or you do that hybrid option where the super fund pays for more of it, but you still pay for a little bit yourself, which, as you were sort of saying, mitigates then any of those risks.
Yeah, those potential risks. So I guess, to follow on from your summary, generally what we recommend is clients that have the cash flow to be able to afford income protection, they pay for it out of pocket and claim the tax deduction. For clients where they want a direct cash flow elsewhere, say reducing debt, or other areas, they've got other priorities and they don't want to pay for that out of pocket, then our second option that we always tend to recommend is the hybrid option. But I guess worst case scenario, if they don't have any cash flow to afford it, then we look at the super fund, knowing that there are some risks of doing so, but it is better than having no cover at all in most circumstances.
That's great. Thanks for your time.